So hang in there with me. This last session is profitability ratios. This group of ratios have particular importance to decision makers, so that would mean your internal decision makers, that are concerned with profitability analysis. Creditors are concerned with profitability as well because it indicates an ability to make required principal and interest payments. Stockholders or shareholders are very interested in profitability because of related increases in stock prices or dividends paid to shareholders. Managers are also concerned with profitability, and it's often related to performance evaluations and tangible rewards from bonus payments and other incentive compensation plans. So in reality, everybody involved with your business is interested in profitability. So the first ratio that we're going to begin with in the profitability ratios is what we call return on assets, or ROA. Return ratios measure the relationship between a return and a specific investment made in the company by various groups of investors, creditors, and owners. There are lots of return ratios, and several of them we're going to be discussing here in this session. Return on assets, ROA, considers the return to investors on all assets they've invested in the company. Because we are measuring a return to the investors, net income is often adjusted by the interest expense that's paid to the creditors, because we only want to measure the actual cost of the asset, not the extra money that we had to pay to get the asset because we didn't have cash. So when we look at the return on assets, I know you're looking at this formula and you're going, oh my God, I hate math. This looks awful. But I'm hoping to break it down for you and simplify it where you're going to have a comfort level. I know it looks pretty gnarly here. So let's go ahead and begin with net income. Net income will come from your income statement. Okay, that's going to come from your income statement. Okay. Your interest expense is also going to come from your income statement. Okay. And then you're going to multiply it times the net of tax. And the formula for net of tax is 1 minus the tax rate. And I don't know why they don't put that here. So net of tax, which is 1 minus the tax rate. We also are back again to our average total assets, remembering that the average for us is beginning assets plus ending assets divided by 2. Now let's take that down here into the calculation. So here, number 1 is the net income, right? Number 2 is the interest expense. So here's your number 2. Here is the net of your tax rate, which is number 3. And so we have to assume here that 1 minus the tax rate, that the tax rate had to be 30. And down here in 4 and 5, we have your beginning assets and the end of your year assets. Here you can see where we've calculated, number 6, the average total assets. Now let's go ahead and put all those numbers together. So we have the net income plus the interest times 1 minus the tax rate gives us in the numerator $99,900. We have our assets at the beginning and the end. We divide it by 2. And we get the $835. So we take $99,900 divided by the average assets, and we get 11.96%. So if we want to break this down, this says for every $1 of asset that we invest, we make 11 cents in 2012. In 2011, we made 14 cents. So obviously our assets are not giving us the same return that they did the year before. Obviously, the higher the ratio, the better you are. The higher the ratio, the better we are. Okay? Now what we want to do is we want to take a look at a second return item, which is return on sales. Our ROA ratio from the page before can be broken into what we call margin and turnover components. Return on sales and asset turnover. So this is going to be our margin component. Return on sales measures the income generated as a percentage of sale. In case of Robin's Boutique, it has declined in the current year as compared to the prior year. So I want to make sure that you guys realize this comes from our ROA, same way you do the calculation there, except for now, instead of dividing it by average total assets, we're dividing it by net sales. Now, and that would be net sales, not average net sales, but net sales for the current year. Okay, so that is different, no average here. All right, so what this is telling us is that in 2011, for every $1 of sales, we made 15 cents. For every $1 in 2012, we made 14 cents. So that means that for every $1 of sale in 2011, we were more profitable. Obviously, the higher this percentage, okay, the happier you are as a business owner. Now let's go ahead and take a look at the turnover component of ROA. And we're going to take a look at the asset turnover ratio. So the asset turnover ratio takes our net sales, that would be from your income statement, not net income, not net income, net sales, okay? Divided by your average total assets. And what that means, again, so that's beginning total assets plus ending total assets divided by 2. Okay? You can see we keep redoing things, so that keeps reinforcing things that we learn, and we keep doing them. In this particular calculation for Robin, and what the asset turnover ratio tells us is it measures the sales generated as a percentage of assets. In other words, what are our assets generating in sales? In the case of Robin here, the ratio declined in the current year. Lower asset turnover ratio should be of a particular concern to management. So that means that our assets are turning less sales year over year, and we would want to know why. Now, we've been doing Robin's Boutique all throughout these sessions. What we know is what? They aren't selling what? You're right. You all should have mouthed to yourselves inventory. Our inventory is taking 165 days to sell. Our cash and inventory are taking 219 days to be collected. So this is causing a problem throughout the business. Now, let's go ahead and take a look at another return ratio. And this return ratio is return on common stockholders' equity. And so students struggle with this one for a little bit. I'm not exactly sure why, but I think I'm going to try and make sure that you hear me, whether or not you digest it or not, I'm not sure. But it's a fairly easy calculation. And what it's telling us is it measures the return to common shareholders as a percentage of stockholders' equity. In other words, the ratio indicates that common stockholders, in this case, and we'll go back to the calculation, are earning 17% return in 2011 and only 14% in 2012. The adequacy of return on shareholders' equity or stockholders' equity depends on a number of factors, including the risk of the investment. And so what I need you to understand is if I'm a shareholder or you're a shareholder and you've given money to Robin's Boutique, you want this number to be high. Just like if you invested in a company and you got a 20% return. This is showing that for every $1 of shareholder, they're only making 17 cents. And then it drops down to 14 cents on their $1. And so it's important that the shareholders see that their money is making money. And you do that by taking net income minus preferred dividends, which we'll be talking about this week. And actually last week we did it. And most of the time you won't have these. These aren't very popular any longer. Divided by the average common stockholders' equity. So that would be stockholders' equity beginning plus ending divided by 2. Now remember what's in stockholders' equity. Common stock, and most of the time in your world, retained earnings. Okay? You need to add those two together, beginning and ending, and then divide by 2. And I think that's where students struggle is they try to just take the common stock, but remember retained earnings is part of shareholders' equity. Because remember, retained earnings holds the profits you made on sales. And the shareholders get to share in some of that. I'm looking forward to your questions as well as the opportunity for you to take this knowledge that we just did here in these sessions and apply it to some problems on Cengage. And then you can answer questions also about what is it that these ratios are telling us. What we need to remember is the calculations, although they seem daunting right now, are the easiest part of ratios. The most important part of the ratios analysis is what are they telling us and what we can do to help change our business with what they told us. Remember that there are limitations based on the way that our financial statements are prepared, and that ratios cannot be used all by themselves. As you've seen through these sessions, you've seen that, oh, well, we took this ratio compared to this, or now I know why the return on inventory now enters into our return on assets and why that's low. You can't use one as an island. They have to be used all together.